Good morning. These are the things that matter most before Wall Street opens. Oil is back above $90. Airlines are already showing margin pressure. Big tech earnings are turning into an AI spending test, and market breadth now depends on proof rather than headlines. The central market question is simple. Can Wall Street still reward strong earnings today, or does the oil shock force investors to separate durable profit stories from crowded narratives? Start with oil and the Middle East risk premium. CNBC reported that U.S. oil topped $90 and Brent moved above 98 after tanker strikes off Saudi Arabia. MarketWatch said oil was nearing $100 after Houthis claimed strikes on Saudi tankers. In the pre-market snapshot, S&P 500 futures were down about 0.4, Nasdaq futures about 0.5%, WTI crude was up more than 4%, Brent was up more than 3%, and VIX was firmer. The cleaner side is energy producers, oil service exposure, and companies with pricing power. Pressure sits with airlines, transport, lower margin retailers, and consumers if fuel costs stay high. For private investors, the useful filter is confirmation. Do oil stocks lead? Do airlines lag? And does volatility stay firm? The second story is the direct airline and consumer margin test. CNBC reported that American Airlines cut its 2026 earnings outlook as fuel costs spiked, and Investing.com confirmed the full-year profit target was trimmed. That turns oil from a chart into a transmission chain. Fuel rises, guidance changes, and margin estimates have to move. Potential winners are businesses that can pass costs through without losing demand. Pressure sits with airlines, cruise lines, delivery, trucking, and lower-income consumer exposure. For private investors, the question is which companies can protect margins before the market starts punishing guidance. The third story is the AI earnings proof test. CNBC said Alphabet and Tesla were testing Wall Street's patience as AI spending overshadowed growth. MarketWatch warned that AI stocks are showing a market split, and Investing.com said big tech earnings revived AI spending worries. The message is not that AI is over. The message is that spending now has to prove returns. The cleaner side is cloud demand, semiconductors, data center suppliers, and software names that can show revenue, margins, and guidance support. Pressure sits with mega-cap names where CapEx rises faster than visible returns. For private investors, AI matters only if Alphabet, Microsoft, NVIDIA, Broadcom, AMD, Supermicro, Tesla, and the data center chain confirm profits, not just ambition. The fourth story is earnings quality beyond megacap tech. MarketWatch argued that beat-and-raise reports are no longer enough to push stocks higher. Near market highs, investors need guidance, margins, cash flow, and breadth, not only headline beats. Potential winners beat, raise, protect margins, and explain demand clearly. Pressure sits with companies that beat low expectations while valuations already assume a perfect second half. For private investors, the takeaway is discipline. Read the quality of the beat, not just the word beat. The underappreciated story is Nasdaq. Investing.com reported that Nasdaq profit rose on high-profile listings and robust data revenue. That is quieter than oil or AI, but it is a market plumbing signal. Listings, trading activity, and data revenue show whether risk appetite is broadening underneath the index headline. The cleaner side is exchanges, brokers, data providers, and capital markets businesses if IPO activity stays healthy. Pressure sits with speculative listings and small caps if higher oil or firmer volatility shuts the window again. For private investors, this is the breadth check. If Nasdaq, brokers, banks, and small caps confirm together, the market has more support. Here is the stock-led watch list. For the oil shock, Exxon, Chevron, and American Airlines test whether crude becomes rotation or margin pressure. For the airline transmission chain, American Airlines, Delta, and United show whether fuel costs are isolated or sector-wide. For AI, Alphabet, Tesla, and NVIDIA test whether CapEx becomes earnings proof. For earnings quality, FedEx, Walmart, and Target test whether margins survive the consumer cost squeeze. For market plumbing, Nasdaq, Robinhood, and Goldman Sachs test whether listings, brokerage activity, and capital markets confirm broader risk appetite. Market bias, cautious, and proof-driven. Futures are softer, oil is higher, and VIX is firmer, so this is not a clean risk on open. The strongest setups are where earnings quality, pricing power, and margin proof can survive higher energy costs. The mistake to avoid is treating every earnings headline as equally important. Today, the market asks one thing: who has real proof when oil, volatility, and AI spending all raise the bar? That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.